so that allocation cannot be distorted in favor of low tax jurisdictions. And how you do that, that's a debate that is taking place at OECD and hopefully at the G20 as well. Now, fair tax debate and BEPS, which is really the same issue again, that are the countries getting fair share of the tax? Now, there, the fair tax debate could be between the taxing jurisdictions. And that's where India comes into play. Is India getting a fair share of the tax pie, even ignoring the tax haven activities? And I'll give you one or two examples of that. Tax transparency through cooperative compliance. This is a new development taking place in the global arena of cooperative compliance. So as opposed to having the standard system of mistrusting the taxpayer, assessment officer comes and gives an assessment with no opportunity to talk and negotiate, but go to the courts and let the courts decide what the outcome will be. That's exactly the opposite of cooperative compliance, and there are different models of cooperative compliance being experimented in countries like Netherlands, where the taxpayer and the tax officer sit down from day one, transaction by transaction, as opposed to waiting till the end of the year when the returns are filed. Then, of course, automatic and multilateral exchange of information. So this is where all the debates are taking place. Now, in the case of BEPS, there are some specific issues of interest to developing countries, as Barry mentioned. And one common concern is that, and this is also a concern being talked about in India, that companies can take profits out of India, or the companies can take profits by charging a very high management fees, royalty, or fee for technical services. And those items are taxable usually in the country where the income is flowing to, not the country where the income is arising. So these countries have an interest in making sure that there are proper safeguards against excessive payment of income in the form of even management fees, fee for technical services, and royalties. And India has made very significant changes in the last 2 or 3 budgets on the definition of royalties, for example, the software royalties. Profit shifting through supply chain restructuring and reallocation, risks and profits. Now, this issue is precisely the transfer pricing issue that India is facing today. And I think many of you in the room are aware of the difficult battles the software industry has had about what is the amount of profit that should be allocated to the outsourcing centers in India where the software is developed, where the marketing services are BPOs and KPOs. Difficulties in obtaining information to assess and address BEPS. Part of it is really linked to the exchange of information, that if you can have information on secret accounts in Swiss or some other authorities, you can perhaps have better control on the avoidance activities taking place. I think one or two last parts, without going into a lot of detail here, is the last bullet, losing out from indirect transfer of assets, which is, put it differently, is capital gains from indirect transfers. Now, OECD produced a paper on BEPS issues of concern to emerging market or developing countries. Surprisingly, in this bullet, they had no mention of India as a country being concerned about losing out because of indirect transfer of assets. And I was very curious that with Vodafone case being such a hotly debated issue, how come OECD did not identify India as a country with concern on this issue? And so let me just turn to that in a minute. So debate in India. Debate in India can be divided, in my view, into 3 broad buckets. Allocation of the tax pie, shrinking of the tax pie, and abusive tax avoidance. Now, allocation of the tax pie has to do with division of the pie among taxing jurisdictions. So the size of the pie is more or less well defined, and you're not concerned about taxpayers trying to make the pie smaller. But then the question is, how do you divide the pie? And there you have essentially 2 models. OECD model, and the United Nations model. In both OECD model and the UN model, income from business and income from employment is defined to be, is assigned to the source country. So the business income is taxable where the income is arising, and employment income is taxable where the employees are performing their services. Now, with the digital economy, lots of questions have come up as to what is the income that should be attributable to a given country like India. And the view that the authorities have taken is regarding the business income and intangibles. They are saying that India provides a low-cost jurisdiction for development of the technology products, digital, intangibles, whatever they are. And the location savings, as they call it. The location savings should be reflected in allocation of profit to the market where the costs are low. And this has been a very hotly debated issue in India over the past 2 years. Does India deserve a larger share of the profit? Because India provides a low-cost jurisdiction for production or creation of value added. And the view there is, very simply, that if the low cost of production in India is the reason for attracting production here, because the producers can have a lower cost of production, then whether that should be resulting in a larger profit in India depends upon who capitalizes the savings from location. If the producers simply produce the goods in India at a low cost and pass on the benefit of the low cost to the consumers, then there's absolutely no justification for India to demand a larger share of the profit, because low cost did not lead to a larger profit. It simply resulted in India getting a share of the production activity. But if the low cost does result in a larger profit to the producer, then I guess it's a fair debate whether you should have an allocation of those profits in India. The second type of debate has been about the role of the markets. And this is an argument put forward by both China as well as India. Take the example of WhatsApp. WhatsApp has 20 million subscribers, at least the last time when I had a discussion on it. 20 million subscribers in India. Now, India is saying that under the current rules, India gets 0 share of profits from WhatsApp, because WhatsApp was developed outside India. It has no presence in India of an office or anything else. All the communication with the taxpayers or the users takes place via internet or via telecommunications with no physical presence of the WhatsApp operator. And the WhatsApp itself is basically 20 people housed in some place in the US and developing the product. The argument that has been developed by people like Akhilesh Ranjan, is that in creating value added in a product like WhatsApp, consumers play a very valuable role. They provide the feedback. They are a testing ground for the development of the product. So even though there are no physical people present, the consumer's reaction, consumer's acceptance of a product itself is a source of value creation. So a part of the product profit should be allocated to where the markets are located. China has also taken that view on those issues. Now, good news is, or bad news is, that in the case of WhatsApp, there are no profits, no revenues at the moment. Revenues and profits will only come when they start providing marketing services through the channel. But at the moment, there's no profit, nothing else. But those are the debates India is having. Other parts of the debates are, basically there are 8 types of income on which allocation rules are relevant. Profit, business profit, employment income, interest, capital gains, dividends. You have royalties, fee for technical services, and management services. So these are the 6 types of passive income and two types of active income, business income and the employment income. And India has taken a very aggressive stance on items like royalty income. 2 budgets ago, they've defined royalties to be any payment for a software product. And that's a very broad definition. They significantly increase the rate of tax, of withholding tax on the royalty payments as well. Same thing is true for other types of income. And I think, let me just, abusive tax avoidance, Indian views are no different than anywhere else. But let me come to, given the time constraints, 2 issues. In debates that are taking place on these 3 issues, the difficulty with India is that India's own tax system is out of sync. The domestic tax laws for whether domestic taxation or international taxation are still evolving, and they haven't reached a level of maturity that is required for them to participate in meaningful debates. Now, let me just give you 2 examples of in what sense Indian tax system is immature. Look at the corporate income tax system. We have a tax rate of 35% plus on corporate income. But then we have a huge volume of incentives. So the effective tax rate is not 30% plus, but almost 17–18%. But then what India does is that they recoup the value of the tax incentives by adding ad hoc features to the tax system. And what are those ad hoc features? Dividend distribution tax of 20%. Alternate minimum tax of almost the same 20%, which fill the gap that is created between the statutory rate and the effective tax rate. So the total tax rate, including these ad hoc taxes, comes back up to 26–27%. Now, international rules are designed to divide the pie using the statutory rate as a benchmark. But when you have a tax like dividend distribution tax, there's no mention in any of the treaties about a tax like dividend distribution tax. But India has asserted its right to tax dividends. For example, in OECD convention, dividends can only be taxed at the rate of 5%, unless countries negotiate a high rate. But now India is imposing a tax of 20% on dividends distributed. And because it is a tax on the company paying the dividends, not the company or the tax shareholder receiving the dividends, India says we are not bound by the treaty, because treaty limit of 5% only applies to tax applied on the recipient of the dividends, but we are collecting the tax on the payer of the dividends. So this is an example of a unique system India follows, which makes it very difficult for them to negotiate the division of the pie according to the rules of the games that are being followed at OECD level. The last bit I can mention before I sit down is in all the BEPS discussion, the discussions are focused almost entirely on business income and business profits. But even though employment income is now going through a lot of stress, the rule under most of the conventions is employment income is taxable where employment is carried out. Now, when you have a mobile labor force, our software persons go to the US and they are carrying out employment in the country for 2 months, 6 months, or 8 months in the year, and they pay the local tax where the employment is carried out. But then they have a substantial part of the compensation which is paid through bonuses, stock dividends, and incentive schemes of that nature. Now, that bonus or incentive is only payable not when they're performing the services, but on the basis of annual or 3-year performance. So where do you allocate the tax on those incentive payments going to the employees? And those issues, in my experience, are becoming significant source of frustration. But OECD, I think they've got enough on their plate dealing with the business income issues, and they haven't even turned their attention to those issues. Anyway, this is all I have for the timing. Thank you.
Thank you, Mr. Poddar. We had a government representative, Australia's G20 finance deputy, then we had a private sector person, so we are delighted now to turn to a professor, Ashima Goel, to speak on this topic.
Thank you for the invitation and to ICRIAR for organizing and maintaining this very useful dialogue for 6 years in a row. And again, when I was asked to write on this, there's a very nice carrot over there. You've done some work on tax, and you don't realize it's a whole new issue and a lot of new thinking. But it's, I think being a macroeconomist in these times is very exciting because there are all sorts of things happening in the world. And you have to stretch the textbooks to understand them. So it was a useful opportunity for me to think about these issues. And what I'm going to talk about is the evolution of global views on cross-border taxation. In India, this is an emotive issue, and there tend to be extreme views because we came from a sort of leftist perspective where firms were evil and so on, but changed to one where we wanted to attract firms, the competitive tax competition. But these views very often lag the international debate, and we can learn from that debate. This G20 and OECD-led debate on BEPS, where the key issues are growing digitalization and the effect on developing economies. And I'll talk a little bit about the application to Indian issues, especially Vodafone, the GAR, retrospective taxation, and so on. And suggest briefly an extension of the already huge BEPS thing to the BITS, the bilateral investment treaties, where some of the same issues come up, and financial sector stability, the role of taxation in that. So the evolution of thinking, OECD, when it started thinking about these issues, was when globalization was occurring, was taking place. And the focus was to encourage cross-border trade and investment, and therefore eliminate double taxation. But these rules obviously led to some kinds of arbitrage, which was perfectly legal tax planning by MNCs, which led to very low effective tax rates. So after 08, especially when governments needed more revenue, OECD and the G20 also came into the picture, started thinking about how to continue the focus on eliminating double taxation, but also reduce tax avoidance. And I think I won't go into the details because we've discussed these already. But one key point I want to emphasize is that it wasn't going back to the earlier, to the pre-double taxation. It was about reducing compliance costs for firms and consumers with a business-friendly tax administration. And one of the issues which has come up today was, I think Montek yesterday was telling us the key sort of productive area for G20 to focus is where their countries can coordinate. And this is a prime such area because firms have the advantage of mobility. So one country acting alone on the tax issue does not have a chance. Countries have to act together. And at the same time, people have been saying that G20 has not had any success on concrete policy measures, just a discussion club. So I think here there's a lot of potential to have actual success in this area. OECD has made a lot of progress, and we have to see the actual implementation. So the new thinking is about the principles embodied in earlier treaties. Most countries follow some kind of residence-based income taxation. So you can only tax profits of non-resident companies who have some permanent establishment in the country. And similarly, the GST VAT principles on cross-border trade, the firms you have to look through. They're basically collecting agencies for a tax which falls on the consumer and the consumer pays. And but the above in practice turned out to focus really basic principles, such as which were pointed out in the Ottawa Conference on E-commerce, such as fairness, flexibility, because of the kind of arbitrage that took place. But the point is that there are costs for MNCs also in this sort of arbitrage because resources are tied in tax planning. And these are non-commercial. You're not focusing on your core competence, but thinking how you can save taxes. And it led to costs such as expansion of balance sheets of firms, and Microsoft holds huge amounts abroad or borrows at high interest rate because they don't want to take the money back to the US. And there are uncertainties if tax regimes change and so on. So in a way, it's useful for firms also if there's some rethinking on this international tax regime. So once the loopholes are identified, then there is some response. And the focus, as Barry has pointed out, so I won't, is really to look at transfer pricing, the kinds of aggressive tax planning. And one negative aspect this has on domestic firms, because they have to pay more to make up in taxes what MNCs are able, compared to what MNCs are able to avoid. So that hurts the competition. And the G20 in Petersburg laid out this principle in the context of BEPS, that profits should be taxed where economic activities deriving the profits are performed and where value is created. And this was proposed to replace the earlier, it was proposed to replace the earlier OECD model tax convention by mutual agreement on which is the place of residence, rather than some concrete evidence of a permanent establishment. Now, how are these issues, how does the digital economy complicate these issues? So basically it's the same issues, but it becomes easier to do the kinds of arbitrage, to put your key risk and high value items in places where tax is low, and to maximize deductions through interest, royalties, services, etc., which violate arm's length pricing principles which are supposed to determine that pricing. And India is especially vulnerable because it is one of the world's largest exporters of ICT services. And at the same time, we have a lot of foreign inflows. Portfolio investment has been liberalized. And since this is VAT exempt, then there are ways in which for them to totally avoid payment of taxes, to avoid withholding taxes. And then for developing economies or emerging markets, again, similar issues. But the emphasis is on transfer pricing, profit shifting in supply chains, and the paucity of information in such tax regimes compared to more mature ones. And that firms are very often able to obtain treaty benefits in situations where they were not intended, such as withholding taxes on royalties being brought to zero. Then there are pressures to offer competitive tax incentives, and this base erosion can be very serious for emerging markets, because the tax to GDP ratio is very low. Typically, it's about 15% compared to advanced economies, it's 25 to 30%. In India, it's only 11%. And since you tend to have a larger informal economy, the corporate tax share in emerging market taxes is much larger than in advanced economies, so they tend to lose more of their tax base. And in India, we've had certain cases where these have come up, but this issue of base erosion has come up. But there's no clarity. We've had cases which have gone to high courts and then been appealed in Supreme Courts. And you've had conflicting awards or contrary awards, which have followed two very different principles. One is that there is tax avoidance if an arrangement has no commercial purpose. It's just meant to take advantage of lower tax. The second is that the remit of the court, and this was the most famous Supreme Court judgment in the Vodafone case, that the remit of the court is just to interpret existing tax laws. So this led to a reversal of the earlier High Court judgment. The government itself shows lack of clarity on this issue, because as far as FIIs are concerned, the idea was that you need to attract foreign inflows. So the use of the Mauritius Treaty to double non-taxation was overlooked. But in the Vodafone case, they went out of their way to try and tax the sale of assets in a third place. So this is another major issue which is relevant for developing countries, which is the use of techniques to avoid paying taxes when developing country assets are sold. So Vodafone bought shares from Hutchison in Cayman Islands, and IMF has marked this as a form of abuse, indirect transfer, tax abuse, sale of shares rather than the asset itself. So I think our domestic debate should be enlivened by these international debate when we sort of overreact on this, because the media perspective was highly negative, and there was a large foreign inflow, outflow, and so on, and a lot of talk. And then Vodafone went for arbitration on the Netherlands-India bilateral investment treaty. But Netherlands itself, I found this really ironic, is reviewing its tax treaties with developing countries to reduce the sort of abuse that these treaties are used for. So, and similarly, UK has also some kind of retrospective tax issue when there's a case. Before the award, you can tax the company and so on. So, and especially in developing countries, their tax officers are no match for very expert opinion that MNCs can hire, and their opinion-making ability. So part of the solution generally is to have more awareness of these issues and capacity building. So among the solutions is make it easier to establish taxable presence. This is all being discussed in the G20. Barry has talked about it. So automatic information exchange, country-by-country data reporting, and so on. But also in the Indian context, it's important to look at the reduction. We have to reduce arbitrary powers with tax officials. And there was a widespread negative reaction to this generalized anti-avoidance. So instead, the firm bodies have asked for specific anti-avoidance, these councils where they pre-announce that these are possible suspect cases, and then we can discuss it. And so and move towards appropriate, not excessive taxation. And the other important issue becomes coordination across government ministries, because very often they are giving different sorts of tax incentives, their decisions affecting investment, trade, finance, which are not coordinated. One example, and which work in opposite directions. So one example of this is the bilateral investment treaties. And we go to this. So the idea of these was, again, part of facilitating cross-border movement, was to give investor rights against states' possible abuse of sovereign power, to encourage investment. But then it's turned out to, it's being used now to really extract money from countries very often. And although this is easier to do with developing countries as part of aggressive tax planning, but Germany also has been a recent victim. And again, it involves a clever use of treaties for purposes which they were not intended. For example, because Australia is now the host, so White Industries was given an award which came into India, Australian dollar 10 million award by an Australian arbitration council for delays in Indian courts. And here, treaty shopping, a most favored nation clause, which is not there in the Australia-India bit, but in the India-Kuwait bit was imported to show that the government had not provided effective means to the industry for court delays in awarding some arbitration they had won. And in Australia, Germany and Australia both stopped signing bits with this international arbitration clause. There's a backlash against this because arbitration tends to be done by a small, non-diverse, non-transparent club. And in general, maybe there should be some discussion for new model bits also, if OECD and G20 want to take it up. Replace the dominant templates, which very often don't. And India itself, after Vodafone brought this case, this White case, they are now talking about renegotiating. So DIP wants to renegotiate 82 Indian bits which have been signed. So this is another area where the lessons from the EPS could be extended. The other issue, I'll just go over this very quickly because there's less time, is the harmonization of financial sector taxes. In G20, this issue was discussed initially, and but it was discussed in the context of revenue raising. But as we saw VAT issues, the financial sector is generally undertaxed. And another reason for taxes is that they are sometimes a less intrusive and more universal complement to regulation. We were talking about arbitrage because of regulatory buckets. So, and taxes allow more freedom in structuring activities, where regulation sometimes works